Today, we're gonna talk about why you spend your money differently based on where it comes from.
Welcome to Wisdom and Wealth, where we talk about the human side of money. Join us as we dive beyond the numbers, unpacking the psychology of money to equip you with the tools you need to be wise in wealth.
I'm Brendan Frazier, Chief Behavioral Officer at RFG Advisory. And why is it that when we get a tax refund, let's say you get $1,000, you get it in the form of a tax refund and you're tempted to go below it on something like a vacation. But if you were to have earned that same $1,000 as a part of your paycheck, you'd most likely end up just paying bills or saving it like you normally do. Why is that the case? There's an invisible system in our brain called mental accounting. And if you don't understand it, it can be silently draining to your wealth. But if you do, if you're aware of it, it can actually become one of your greatest money tools. So what is mental accounting? It's a concept that was introduced by Richard Thaler, a Nobel Prize winner, behavioral economist, and one of the godfathers of behavioral finance. At its core, it means this: we don't treat all money as equal. Instead, we create mental categories or mental bank accounts and assign money rules differently depending on where that money came from or what it's for. Economists would say that a dollar is a dollar. And logically that makes sense. But in our minds, a dollar of birthday money doesn't feel the same as a dollar directly from your paycheck. And this matters. It matters because those little mental tricks influence almost every money decision that you make, whether you realize it or not. So here's an example, like we mentioned earlier. Let's say you get a tax refund, and instead of saving it or paying off debt, you feel more likely to use it as a reward, so you go and you splurge. And research shows that people are far more likely to blow windfall type money than they are earned income. They're far more likely to blow money that comes from a tax refund, or like we mentioned earlier, money that comes from a birthday, as a birthday gift, than they are their money that comes in on a regular basis like a paycheck. Here's another big one. Many retirees will happily spend dividends from their portfolio, but they refuse to tap into the principal and sell shares, even though it's the same total return. They mentally label dividends as income and principal as untouchable. But that mindset can limit flexibility, and it can also lead to inefficient withdrawal strategies. The truth is, you're probably doing some version of this on your own without even realizing it. And the problem with that is that mental accounting, if left unchecked, can lead you to make what we'll call irrational decisions or negative financial decisions. And here's the thing. You might be thinking, oh, this is just a little thing. This is just a minor blip on the radar. But these little blind spots that we have, they all add up. And over decades, they can quietly start having a big impact and have the potential to derail your financial future. But here's the good news. Mental accounting isn't all bad. In fact, if you know that it's there and you know how to use it to your advantage, you can harness the power of mental accounting and get the benefits from it. So let me give you an idea of some examples or ways you can use mental accounting to your advantage. Number one is you can set up purposeful accounts. You set up individual accounts, create these accounts, label them with a specific job or a specific vision. Things like vacation fund or fund money, giving jar. Labeling these accounts this way triggers your brain to protect that money for that sole purpose. And it makes saving for it and the spending of it feel easy and natural. Another option is the now popular envelope system. So you could have actual physical envelopes. There are apps that sort of mimic that. But the idea is that you're breaking down your budget into physical items. So you may have an envelope for paying the mortgage, an envelope for groceries, an envelope for haircuts, an envelope for lawn care, and every dollar gets assigned to the envelope. You have the same amount of money to spend, but you're using mental accounting to put the dollar into its purposeful slot. Next, there's also a way you can leverage mental accounting when it comes to your investments or your portfolio. You may have one portfolio of investments, but within that portfolio, there are different investments that serve a different purpose. You have some that are designed to be short term, some that are medium term, and some that are longer term. Some investments that, like cash, that you may want to use in the next 1 to 2 years. More conservative investments that you may use in a 3 to 5 year window. And then you have another bucket of long-term investments like your stocks, your equity positions that are more volatile. And so you can look at it from a mental accounting perspective and say, I have short-term, medium-term, and long-term investments. That way, if your portfolio is down, you know that's okay because I've got investments designed to get me through now, to get me through the medium term, and then to get me through the long term. Ultimately, here's the takeaway. Mental accounting is always at work. It can always work against you, or it can help you build a system that makes saving and investing and spending easier. So if we want to start using mental accounting to our advantage, we need to become aware of it. So here's something to try. This week, look at your money and ask, where am I possibly falling into the unhelpful side of mental accounting? Is there an area where I'm using this mental accounting idea without even realizing it? And then ask, is there a way that I could use mental accounting to create better financial habits? Because once you can master this invisible system, once you become aware of it, once you stop being controlled by your money psychology and start using it to your advantage, that's when things change for the better. As always, if you have questions, if you want to talk, if you want to discuss, reach out, contact your financial advisor. Until next time, stay wise and well.